All right, Fed pivot news back in the news, right? That's been the golden ticket here lately is to try to get that Fed pivot, and we got a little bit of that from the Fed mouthpiece, Wall Street Journal mouthpiece, talking about the Fed starting to dial it back after this next meeting. Markets, of course, responded very positively to that because that's what we're looking for is the Fed to stop. That's been the narrative. That's been the idea behind what will rally the markets and get that strong year-end, all-time highs rally again. So it's not the first time, right? We get this Fed pivot every so often, and it came again here ahead of a really important earnings week next week. So I'm going to break down how bullish we were as to whether or not we can now expect to be more bullish. Was today any different than what we've seen? And then what we can actually expect from a technical situation. I mean, there's a lot of things that can throw a wrench into a technical analysis next week from a news standpoint. But the environment going into that news situation, I'm going to break that down into what we can expect to come out of it. So I'm also going to break down some big moves in the markets today and different asset classes. A couple surprising moves considering how bullish we were. And then we'll talk about our trade idea, kind of a very common strategy, a very common setup for that strategy. We'll look at that at the end. So let's go ahead and get started. Today is Friday, October the 21st, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, or the subscribe button down below. Click the thumbs up icon down there to like our video, comment on anything that stood out to you. Join our website at MarketScholars.com with that link. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. As always, if you're watching us here on our blog, check out some of these our upcoming classes, our Market Outlook live video. Come down here, click on that heart. We really dropped down considerably, down to just 70 here. We had been above 100. That's our goal, is to get 100 every time. And so let's see if we can ramp that back up. Again, just click on that heart. You can do it now where you're watching. Click that like button. Same thing here. Click the thumbs up icon. Click that like button. The more you do that, that helps us out a lot. Helps get our content out to all of our followers on those platforms. And you can also help coming down here and clicking on this thanks button. You can show your support with super thanks by clicking on either one of these. We really appreciate those that have been doing that as well over the last so many months. All right, well, let's start off looking at the S&P 500 here with the market forecast indicator. You can see the nice rally we had here at the end on Friday. Got up to the moving average, actually got 1/3% above the moving average, hence the yellow line. It's still falling, but we're above it. That's why you get the yellow line. If you were above it with it rising, it'd be green. So you have the yellow line, you have the light green shading, which means you're rising, but you're not in bullish territory yet. So that's a bearish signal. Bearish signals can be reversal signs to new bullish trends, of course, or these are selling signals. You see this quite a bit when you're in bearish opportunities, right? They're either selling signals or they're the beginning of intermediate runs. One or the other, right? You just don't kind of flirt around. That was kind of this was a little sideways action, but even that ended up being the peak. And then this started the brief intermediate, the failed pullback bounce, right? This being the failed intermediate, the failed correction bounce, right? And then now, here's the potential for it actually still, for us to hold 3,500 would be a very, very tremendous move for the S&P in terms of like the long-term bullish implications. Long-term, I mean going into like the next, 6 months or so, to actually be bullish and get back towards highs, right? The Tom Lee rally, or whether we maintain the bearish trend and initiate a bearish market. So that's the idea there. The momentum line jumped up to the 90th percentile. Of course, it's done it before, and last time it did it, it's almost the exact same thing here. The intermediate line is a little bit higher than it was here, but the momentum line was at 92. The near-term line is at 51. Now the momentum line is at 91, and the near-term line is at 52. So it's pretty much the exact same pattern. And we ended up with a down day there. We couldn't follow through on that really engulfing pattern. We'll see. As of right now, in the futures, we're actually pretty up, in the pre-market Sunday night. But of course, futures market really does not matter in the Asian session, especially because there's only one the futures. The pre-market's already pretty illiquid. The most illiquid time of it is the Asian market, simply because there's only one market open. Europe's not open yet. U.S. obviously is not open. So that leaves the Asian market as the only one is open, and that's the least liquid market out of all three of them. So it helps when Europe opens, but it's still pretty illiquid. It helps when U.S. opens at 8:30 Eastern, right, 8 o'clock Eastern. It starts to pick up some pace, but obviously once we get to 9:30 Eastern, boom, volume kicks in gear, a regular amount of session, which makes the futures volume look like nothing. The intermediate line did jump up above the market sentiment line, so that's actually a pretty good sign. Though still both are in bearish territory, so it's not like we're bullish here. They're still very relatively oversold. We have to get above the 2.5% mark on this level to really consider that we're high enough above the moving average to start it turning around. Getting to that level would also mean that you're getting above these really important Fibonacci levels at 3,800. So you got about 50 points here of gap that we could fill in, but if you break through that, that would change things around. Of course, I lean towards that we're not, because you expect resistance to hold until it doesn't. But if it does break, then we're going to have to start changing our expectations here. As of right now, you expect that bear tag. I expect that bear tag to play out into a bearish move. If anything, maybe a little bit higher on Monday, but ultimately to the bearish leg lower before this intermediate decline that we're on right now is done. I don't think the intermediate line gets above 60 on this near-term rally. I think it will probably get maybe a little bit above 40, but probably maybe even a smidgen above 50. But I don't think it gets above 60 here, which would start the new light, right? That would be dark green shading in a green line, and you would most likely have to be above 3,800 for that to happen. So you'd have to get a resistance breakout. If you take a look at the NASDAQ, let's look at the daily chart first. The NASDAQ, you can see, it doesn't even have the yellow line, so it kind of puts in note, like, we're not that bullish, right? We're barely above the 23% line here of this current intermediate decline that we're on right now. So keep that in mind. SPX, if you look back at SPX, we got above that 23% line today, just a little bit, and still below it on the market sentiment run. The year-to-date run, see the 23% line on the year-to-date run is up here at 11,920. So that's your equivalent for 3,800 on the S&P. We're nowhere near. We're barely above the 23% line on the green line. So grain of salt on how bullish the NASDAQ is. And then finally, the Russell 2000 is not above the 23% line. So the Russell 2000 hasn't been that bearish, but it's also not been that bullish here either. Its intermediate line is crossed above market sentiment. You're above the 30-day moving average briefly. You have the bear tags. So again, either these bear tags play out to another leg lower, which is what I expect, or they turn out to be the tipping point. See, the difference though on this one is by the time you had that bearish tag, you were at 2.75% above instead of just 0.15. Right, you go back to SPX. Over here, you were 2.08%, so not quite above 2.5%, but 2% is a pretty decent number. Over on this bear tag, you're only 0.79, and then on this one currently we're at 0.35. So you see, you kind of need a good amount of bullishness on that bear tag to increase the odds that it starts the bullish run and just doesn't turn into a bearish leg lower. We are moving up on the upside on the weekly market forecast. Your short-term sentiment's rising, though your intermediate line still is below 10. So it's again, extremely rare for the intermediate line to be below 10 at all. The fact that it's now there 2 weeks in a row, one of them being an up week, kind of goes to show just how much we have to overcome. That's why it's going to be hard. I don't think we will overcome it. I think we need to start to move to the upside a little bit first before we can get a good breakout type rally. I don't think we have enough juice here to produce the breakout type rally right now on the S&P. If we take a look at the weekly, this weekly chart, you can see we got a higher close. So this week's important because we have to close above this body to get the reversal. Also, more likely you'd have to get above 3,800 to get the green arrow on this chart, which we don't have right now. So you can see again how important. You do have a bullish candle. It's not that bullish. Again, it has to be no lower shadow. It's more of a transition candle because it's a higher close off of a lower close. But again, we have to confirm that now with a higher close above this body. If we get a close below that body, we're just right back down to being bearish. And that's actually what I'm expecting. The PPO is rising slightly, so that's a good sign. The PPO is as low as it's been. I mean, it's the second lowest of the whole past 5 years, even lower than the COVID, right? COVID, we were at 0.582 at the lowest point. We're at 0.6 right, or -6 right now. So it's the second lowest of this whole 5-year period. Only the previous week was lower. So that kind of goes to show just again how we're more bearish now than we were during the COVID, and the COVID was a deep drop on an absolute basis, whereas this has been a lot more obviously gradual. We've been in this pink shading. This is the longest pink shading that we've had. Here, let's go back to, because this is another way to tell bear markets, right? When you've got these extended death cross environments, you can see you haven't had very many. They're kind of broken up right there, but you haven't had these extended death cross environments. This period now we're looking at, this is the period that crossed it. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. So we have now been officially 6 months in a death cross environment. According to the 10 and the 40 week exponential moving average, a proxy for the 50 and 200-day simple moving averages. So you can see over here, this is kind of the other longest period we had. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. And then on 21, we were up. So we've eclipsed that level. This one was broken up with a period in between. You can see these other periods where you were in a bearish market, right? When you were a lot more than 26 weeks. So here in 87, 88, we kind of had that was easily, here from October 26th to June 27th. So that would be an 8-month period of death cross environment, with most of it actually rising because, we had the biggest decline here at the early. And then obviously here's your bear market. Well, that was the 77. There's 81, 82. Here's a pretty decent period where from February 20th to August the 18th, that was almost 6 months, 1 week short of 6 months there in 84. That was kind of a little bit shorter than where we're at right now. There's 73, 74, and of course you can see over here 69 and 70 was also a period. If I were to go a little bit further on this, let's go up to 58. You can see 69 and 70 was also another bear market period. So you can see the bear markets, right? They stand out here. There's these extended declines and now here we are again exactly 26 weeks. So 6 months now exactly that we've been in this environment, and we're nowhere near getting out of it. So again, I think it's more likely that we're going to be in this type of bear market, most likely this one, over here 2000, 2002, because we got some similarities from a sector weighting standpoint. We also have some similarities here to the 73, 74 in terms of the inflation and rate hike campaign that the Fed is on during this standpoint. Again, you had a 15% gap at the worst there in that one. In 2000, you had a 10% gap. Of course, the financial crisis, you were a 20% gap, and right now we're at 6. So you can see how, when we talk about how we haven't started the bear market yet, we just haven't. The 6% gap's not that much of a gap, and 26 weeks is not that long for an extended bear market decline. Like this one we started over here in October of 2006, and it ended in May of 2003. So you're looking at 2 years plus another 7 months of death cross environment, of the 10-week being below the 40-week. So 26 weeks, people will say, well, the average bear market's 26 weeks. Because a lot of those Doofenshmirtzes are saying that this here is a bear market. And it's like, it doesn't take my freshmen in high school can realize that that's not a bear market compared to these two. And so that these get included in that definition and that average, and that's why they say, well, the average is 20 some odd weeks for the, this is not, 26 weeks is not, that's not a bear market, right? That's if we're starting one, we're going to be in one more than more than 26 weeks. Even going back to 73, 74, which I said is another period similar to what we have now. We started it in April of 73. We had a brief little period there, but we really ended it there in March of 75. So almost 2 years of death cross environment minus a couple weeks in the middle. All right, so 26 weeks, no, this isn't an average. We haven't met the average, right? When you look at the 3 green arrow charts, remember the Dow is the nice one here. So the Dow has got the right here. If we are still in correction, if this is a correction, albeit a very long one, 26 weeks is a very long correction. It's a very unbelievably short bear market, but it's actually a very long correction, as you see, right? As you saw with all those other periods in between, they're a lot shorter since 2008, 2009. And so if this is just if we're bottoming at 3,500 and then rallying, Tom Lee rallied back up, then the Dow has given us the hope, because we've had now 4 days in a row of 3 green arrows, the green shading here. We've had a couple of days here with the Russell. We haven't had one at all yet with the NASDAQ, and we've now had one with the S&P. So again, if this is like the same thing as that bear tag, when you get 3 green arrows on a downtrend like this, it's a bearish signal, or it's the beginning of a run. So how do I know if I get a second, third, fourth day, right? So one day doesn't make it. So one day says, again, in the bearish trend with resistance, I expect it to hold. So one day is actually our sell signal, knowing that if I get a second and I get an extension, especially above 380, then we've turned it around, right? We're going to be up and be bullish here for a while. So it's, we've got that bearish signal here going into the week. Very important week, mind you, with a lot of earnings. The other positive sign that you have that we might be stopping at 3,500 and rallying up to creating that Tom Lee rally that you're, probably not the year in now, but the beginning of next year move to all-time highs or back up to the previous highs. The other positive thing is that we close above multiple averages today. We closed below the 8-day on Thursday, and then now we've closed above the 8, 17, and 30 today. Now there's a wide gap between the 30 and the 50, and those big, huge moving or Fibonacci levels are sitting right in between, right on top of each other. Multiple layers sitting right on top of each other, which increases that strength. So that's the downside, but the positive side is we close above multiple moving average. You also have a lot of resistance, a whole 1 year value area sitting above us right now. So that's also it's a heavy burden sitting on top of current price. The MACD is rising, the stochastics is rising into bullish territory. The MACD is rising towards 0, but again, you would expect that we'll probably hold this resistance. By the end of next week, we'll probably be closer to 3,500 than we are to 38, considering the technical patterns that are setting up right now. The negative indicator on the DMI is below 25, but the positive is nowhere near 25. So there's nowhere near a crossover here, and the ADX is really high. So if we're going to be bullish, we should be a lot more bullish than this. In fact, that brings up the unbalanced volume, which has been our problem. When you look at it normalized with the price, that's what the money flow looks at. You look at where we're at now compared to where we were over here on September 22nd. September 22nd, we closed at 374.22. To Friday, Friday here today, or this, I'm doing this on Sunday, but on this Friday, we closed at 374.29. So we are actually higher now by 7 cents than we were on September 22nd. But if you look at the unbalanced volume, we are nowhere near those levels, which means we're not getting enough volume on these up days at the price levels to offset what we're getting on the downside, which is fine. I mean, the volume should start tapering off once you're in a green shading and dark green line. It shouldn't be tapering off right here when you're trying to get established there. That's why we can't get going. That's why that was such a fake out. Right, when you looked at where we were here compared to over here, right, the volume over there on 5/3 was way up here, and you look at where the volume was on that mid-August peak, we're nowhere near it. Hence the fake out, and again, I think that's the other reason why this will most likely be a fake out as well and produce a downward sign. Again, very similar to this, even this one, that wasn't enough volume to match what we had previously, and it wasn't enough, right? And we started the leg lower. I think we're going to get the next leg lower too. RSI and CCI are not bearish, but they're in the midpoint, so they're not really bullish either, so they're more neutral. The bullishness has not been enough to offset the strong bearishness in the S&P. So we're way below the cloud, nowhere near being above the cloud by the time it turns pink, right? So sometimes, if you go back, when you get these pullbacks, if you can be back above the cloud by the time it's peak, and obviously you need to be above it by the time it turns green again, but by the time it turns pink, then you're okay, right? That would be okay. That's not a bad sign. So here you get the pullback, which is what the pink is. The pink is this pullback plotted forward by 26. So by the time you're back above it, so here it is again, and we're above it by the time you turn pink. But when you're below it, by the time it turns pink, then you're more bearish, and that's the case here again. Where it's about to turn peak, we're nowhere near being above it. That's how it was over here. That's how it was right here. We got that last leg lower. And this we got another leg lower too. And I think we're going to get another leg lower here at the beginning of this pink area before we stall at that 3,200 level, or maybe the pre-COVID peak about 3,380-ish is where I ultimately think we're going to end up stalling to. From a Bollinger Band standpoint, so this is the reason why we've been consolidating. The bandwidth was really high on that leg down. We consolidated, and now I think we get one more. Now we're going to start breaking out. So if we are going to break out to the upside, we got to get above 100 on here. So obviously we're at 67. We're not even in the upper quartile. So that's an important level to watch next week too. But if we drop back down to the lowest quartile, then you see why we'll more than likely be bearish, right? Especially with the bandwidth starting to rise again. With the bandwidth way inside its Keltner channels. Here, the bandwidth way inside the Keltner channels here with the red dots, and the bearish momentum has waned here. So you'd have to break back below those bands to get inside that space, to start pushing the bands outside of the Keltner channels. In one way or the other, but I expect it will more than likely be down to the downside. The other thing that really stands out too in terms of why I believe will be more bearish, you can see we're below 100%, and we've been pulling back on volatility, but not nearly as much as the volatility of the VIX has been. The volatility of the VIX dropped all the way down to 87. That's a tremendous drop in the VVIX that was not accompanied with a sharp drop in the VIX. Right, which, the VVIX is setting up for a pretty decent spike here. Like when you look, here, let me do the correlation chart. Let's pull the VIX up here. When you look at how, how strong the VVIX is, how big of a drop that we've had, and let's go on a weekly chart here. That's a pretty tremendous drop. You've seen kind of tremendous drops here. But when the VIX has been high, and when the VIX has come down with it, then we stay down. But when the VIX doesn't come down with it, we tend to just come right back up, come right back up, come right back up. And I have a feeling that we're going to be coming right back up again off of a higher low. And again, considering that it's 95% correlated with the VIX, or 78% on the weekly chart, that probably means that we'll come right back up here on the VIX too. Also, when you look at the VIX, compared to some of its average levels over different time frames, it's still at its 30-day average, so it's not even dropped below its 30-day average level. So the VIX, the 50 just crossed above this 200. So the VIX is pulled back, but it hasn't pulled back enough to change these averages to the downside here. I forgot to show this chart here. We did get an outside day, so a lower low and then a higher high, but the low really wasn't that much lower. We obviously are closing near the high. So when you look at the Arun indicator, which is a graphic representation of that 4-week chart, we are now below 70. So that's the other positive sign that we could break out next week, is because we could get, now that we're below 70, you can watch for that breakout on the green line to 100. That means we have to get above 380, 379.46. That would get us the green line spiking to 100. That would be a bullish sign, right? And the red line would continue just to move down. But if the green line continues to move down, and we move back down towards 348, then we're susceptible to the red line spiking back up to 100 instead of the green line. So something very similar to here. So instead of moving back up to the 4-week average, we moved back down and got a new 4-week low point with the red line spiking to 100. So Right now they're both dropping because we're not getting either one of them. They're both moving to the first day of the period. But the 4-week low is far enough over now that we can be looking for the new 4-week high point to signal the turnaround, the beginning of the trend, the intermediate trend, and we're not quite there. 380, really important. That would signal a change of what we want to expect if we were to start to get that, especially early next week. All right, now let's take a look at what's driving the price action today. Interestingly enough, yield still finished the day higher, but the dollar was down, and that's obviously what really pushed up. Again, the idea was that the Fed's going to stop raising rates early. Again, that did not stop the bond yields from rising. The long-term bond price is still really dropping parabolically, right? The dollar, though, did drop for the first time. A 1% move. It's a really big move in the dollar. Commodities were flat, lagging behind equities, and really the Qs, IWM, everything really outpacing. Even gold benefited from that big drop in the dollar. Let's back out to the beginning of the week. So we'll go out to the 17th here, and you can see, that despite the big rally in equities, they kind of they finished where they were early this week on Tuesday morning. So Tuesday morning we really gapped up pretty strong. We gapped up on Monday, we gapped up again on Tuesday, but we filled in the Tuesday gap and started to fill in a little bit of the gap this morning from Monday, but then ended up finishing at Tuesday's high, right where it opened. For pretty much everything except for real estate. Real estate pulled back. IWM also did not quite get back up to those highs like the Qs did. Emerging markets and developed markets pretty much right about the same levels as they were Tuesday at the open. High yield was down, but bonds and commodities were pretty much same level. The dollar was pretty much same level, but the bonds are the ones, again, really kind of an outlying move. So it's like the bond market not quite buying this idea that the Fed's going to be done raising rates, as you can see, moving all the way down to 93 now. New 52-week low. I mean, if you go back out to, quite a few years, 5 years, I mean, we are well below the 200-week moving average. So the bond market is in a bear market. It's in a tremendous bear market. It's the biggest bear market that it's had. We are not at the lowest point. There's a little bit lower here. We're at minus 5.3. We're at minus 5.2. But needless to say, like, this is one of the bigger ranges that we've had, 7.4 point range. To give you an idea of how that aligns up with the average on a weekly basis, so 7.4 range here. The average here is 4.4. So I mean 7.4 is way up here. So really big range. The biggest. So we've had 2.65, 4.2, 4.5. You have to go all the way back over here to 6.72 to get some ranges that were even anywhere close. One of these was at 6 points. This one 6.27, 6 on that range. This was 7.72, so a little bit higher. So that was, the kind of the biggest drop. You were kind of breaking below some lows. Here, I think it's kind of a parabolic peak. You would consider kind of a washout move or a bullish move. To get that big of a range, well above average and well above what we've seen. And if you look at the volume here, so let's look back over here and go back to the 5-year and look at the volume, you can see it was above average. It was relatively high volume for the week. We had a higher volume a few weeks ago, but you can see how it's really kind of tapered up here to the upside. So, and if you go to the options expiration, because we just had options expiration, right? So if you go to that level, we just barely finished. This is the end of an options expiration cycle. This period, you can see it was a tremendous move, 15-point move. The PPO, as low as it's, as it is, very, very bearish, and a lot of volume over this entire expiration cycle compared to what we've seen. So I would venture to guess that this is one of those parabolic peaks that you're seeing right now in yields, up to 4.21%. A tremendous move to the upside on an options expiration basis. When you're using that monthly basis, right, that time frame. So you wonder if bonds are starting to kind of find their limits. If you look at UUP, an engulfing pattern. So the dollar's got some opportunities to start to falter. We've had an engulfing pattern before. We've had a few here. So it's not, we've had what, this one, all engulfing patterns, all short-term reversals, but none of them, the reversal that breaks you down and gets you and keeps you below the 17-day moving average, right? This is actually the first one that actually did close below the 17-day moving average out of those other three. And the MACD is already below its levels there. Commodities, your other big mover, right? Those are the three big drivers of what's going on. And commodities are, look how tight that commodity move. Like all these moving averages sitting right on top of each other. When you look at the Bollinger Bandwidth for commodities, it's really starting to drop down. You can see how bearish it's been. If you look at it on a longer term view, you can see that how bearish we've been, and this decline that we've had that kind of spiked out. The rally, of course, spiked it up, and then the decline got it going again a little bit to the upside. But you can kind of get an idea that look at this level here. Let me get rid of this expiring cone. But look at this opportunity that commodities have an opportunity here to really break down hard. Because you're below that 23% retracement, so you're in long-term retracement mode. You have no volume below you on a long-term basis because we rallied so fast this year. You have no volume below you, and if you look at the 5-year version of the weekly version of this chart here, we are sitting right at the 50-week, and again, there's no volume down here. So we can really drop hard and drop fast towards that 62% retracement level. This is the fourth quarter 2018, well above the pre-COVID peak. You could really drop down to that level, and that would be a severe correction. That's a big gap between the 50 and the 200. Really, really big gap. One of the biggest. I would venture to guess probably the biggest that this ETF has had. Let me go back here and see. And then we'll go here to max available. Yeah, it is the biggest gap. Probably was a little bit bigger here. We just didn't have the 200-week moving average going. But probably pretty similar in terms of how size. But you can see when you started that correction, you were in bear market. You can't really correct a big bullish gap like this. It's one thing to drop hard when you're already bearish. It's another thing to drop hard when you're really bullish, right? When commodities have been bullish and now they're just not. So there's a severe contraction. And remember, commodities don't drop unless there's just no demand for them. And no demand for them to that scale would suggest, very low economic output would suggest, again, moving towards recessionary levels. So we're kind of in a catch-22, a jump back up above the 23% line and back above those moving averages. Jumping back up here this week, which is what I expect actually what will happen as the dollar starts to pull back. I expect commodities will actually have a run back up towards these highs, one last little hurrah. But a jump back up keeps the inflation story very prevalent. A drop down is recessionary. So which one? All right, which one do we want? Do we want the severe drop in demand, which is not going to help companies and economic output? It's a reflection of very poor economic output. Or do we want the inflation story to remain a big part of, which is obviously, as we saw Friday, the market will respond very favorably to the inflation story going away. So we're in a little bit of a catch-22 in terms of where commodities are at right now and where they could ultimately end up going. I think ultimately you probably just want to stay right here. Best case scenario is you just stay right here. You don't go up anymore, but you don't drop either, and you just kind of stay between this 38 and 23% retracement and build up this big volume node and let this gap kind of fill in naturally or shrink naturally as we just go sideways instead of filling it in on a decline. Again, that's the best case scenario, and I think that's by far the least likely scenario to happen. I think the more likely scenario is you jump back up. As the dollar starts to pull back, you start to jump back up in commodities, again, reigniting the inflation story, keeping rates moving higher until you have the demand destruction that drops it into this gap and fills it in, and ultimately that would be coincident with a bear market similar to last time we had that. All right, one last look here at the sector move. So let's take a look here. what's going on from a sector rotation standpoint. So here we go. And let's just take a look first on what happened on Friday, October 21st. Whoops. Let's get this down to like a... So you can see materials and energy were the biggest strengths. Of course, the dollar was down, so that's going to push those higher. Financials benefited as well. The yield spread actually improved quite a bit. You got up to 27 basis points. That's a big right now. You remember a rising yield spread. Remember the stock market peaked in mid-August, and as the yield spread rose, the stock market declined. Right? You saw that over here too. You had here at the end of March, you had that other fake out with the really big drop in the yield spread, and then as it rose, the stock market dropped. So I don't know if we want the yield spread to rise. It's been coincident with kind of some bearish moves in the market here lately. So we'll kind of keep our eyes on that over this next week and see what the yield spread does. But I did want to show one more thing while I'm on this chart, and that's the new highs and new lows. Let me make sure I have it updated. But yes, so the new high, as bullish as we were, crazily, as bullish as we were on Friday, the new highs minus new lows index, which includes the New York Stock Exchange and the NASDAQ composite, the whole NASDAQ composite, not just the NASDAQ exchange, excuse me, not just the NASDAQ 100. But we dropped down to minus 921. So as bullish as we were, it was not coincident with a sharp drop in new lows, which would, I mean, even just you don't even have to have a bunch of new highs. Just a sharp drop in new lows would have brought this up. But we had so much fewer new highs and a lot more new lows, despite the 2% rally in equities, that this dropped down to really, really low levels. In fact, dropped back below its average there. So, and then your skew index, you can see is still really, really low. And that's not necessarily something you want to see either on a bullish move. You kind of want to be already above it and now starting to drop. But you can see when you're below the average, you tend to be bearish. When you're below the average, you tend to be bearish. When you're below the average, you tend to be bearish. We're below the average, and we're bullish. So I would say that that's more of a false bullish move here. All right, now let's take a look at our trade idea of the day. I want to take a look at ADSK. So let's pull that up here. ADSK, you can see the intermediate line is similar to the market. It's above its market sentiment, but at a higher level. Remember, this crossover is down here for the S&P. The short-term sentiment is not as bullish. The momentum line is not as high. The near-term line is not as high. We're not above any of these highs. We're kind of, we do have dark green shading because we're above 50 on the intermediate line, but we're still only have a yellow line, which means we're above a falling moving average. When you look at the long-term chart for ADSK, you do have a green arrow, you have a bullish candle, but you can see we're not really like closing strongly bullish here. The PPO is rising, so at pretty negative levels. When you look at the 3 green arrow chart for ADSK, we've had 3 green arrows for a while. Putting those averages on, breaking out those averages, you can see we are converging all around this point of control. And so a big volume node here for the past few months. All the averages sitting down on top of each other. The Bollinger bandwidth has been coming down as at low levels. The DMI, the ADX, both those lines are at 25, so neither one of them are really trending. The RSI and the CCI, you can see, are at very neutral levels, both of them right in the middle of their charts. The trend strength is gone, so there's no trend strength. Hasn't been for a couple of weeks now. You're right around the cloud, so pretty neutral, especially considering, again, especially considering you're right around the point of control. All the averages are, and you've got this big node, pretty much one volume node for the whole year. Some volume up here, but we've been here for so long that you got one big volume node. You're sitting right at the point of control. So again, that sets you up for doing an iron condor spread for November, going out to the low 20s on both sides. It's a $10 wide spread on top because that's what we got. So we have to double it up on the bottom side at $5 wide. So that keeps your risk equal, though your risk to the upside, again, you got $10 to get to maximum loss, where you only have $5 here to get to maximum loss. We didn't equalize that, but I'm not so much concerned about the upside risk, because again, the broader market I feel is more bearish. So you can see that, and another thing too is you do have, let's see here, let's go to the 1-year chart. You do have earnings coming out after November expiration. So, even though I am position size smaller than normal, but because of the $10 wide spread, I have to be, because I can't double that up. I go over my risk. But I got a normal return. So it's almost like I do have, a pretty decent return for a lot less risk, which again frees up that other $400, $350 to use elsewhere, and still get a pretty decent return on that, instead of using it here to get the normal return, even without the extra risk involved that's normally associated with this setup of that earnings announcement. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Also, remember you can join our website at marketscholars.com for free. Like us on Twitter and Facebook. Have a great rest of your weekend, everybody, and we'll see you all on Monday.